December 31st, 2025. Right now, as you're watching this video, the same ounce of gold is selling for two completely different prices. In London, $2,750 per ounce on the LBMA exchange. In Dubai, $2,890 per ounce in the physical gold markets. That's a $240 premium on the same metal at the same time. If it's the same gold, why are the prices $240 apart? The answer will change everything you think you know about the gold market. And by the end of this video, you'll understand why that $240 gap might be the most honest price signal in the entire financial system. Welcome back to the channel. I'm John, and for the past 3 years I've been tracking the real story behind precious metals markets, not the sanitized version Wall Street wants you to believe. Over the next 16 minutes, I'm going to show you exactly what this price split means, why it's happening now, and what it tells us about where gold is really headed in 2026. If you want to stay ahead of the biggest wealth transfer in modern history, hit that subscribe button and turn on notifications, because what I'm about to show you won't be covered on CNBC. Let's dive in. First, let's understand how gold pricing actually works, because most people have no idea they're being shown a rigged number. The LBMA, London Bullion Market Association, sets what's called the spot price of gold twice a day. This is the number you see on financial websites, news tickers, investment apps. But here's what they don't tell you. The LBMA price is based on unallocated gold. That means you don't own specific bars. You own a claim to gold somewhere in a vault. It's basically an IOU. The vast majority of gold traded in London, we're talking 95% plus, is paper gold. Futures contracts, ETF shares, digital certificates. Very little physical metal actually moves. Now flip to Dubai, Saudi Arabia, and the broader Middle Eastern markets. Here, buyers demand physical delivery, not paper, not promises. Real metal you can touch, store, and control. When you buy gold in Dubai, you're walking out with bars or coins, or it's going into an allocated vault, meaning specific, segregated, serial numbered bars with your name on them. Under normal circumstances, physical gold should trade slightly above spot. Why? Transportation costs, refining fees, dealer markup, security and insurance. A normal premium, $30 to $50 per ounce. That's fair, that's logistics. But $240, that's not logistics anymore, that's a warning. This price split exposes something Wall Street desperately doesn't want you to understand. There are two gold markets, one for the masses, one for the elite. In the West, we're taught to trust institutions. Buy a gold ETF, they say. It's convenient, liquid, no storage hassles. What they don't mention, you're buying exposure to gold's price, not gold itself. Read the fine print on any major gold ETF, GLD, IAU, whatever, and you'll find these exact words. Physical delivery not guaranteed. Translation? In a crisis, you get cash settled at whatever price they decide, not the real market price. The LBMA operates on fractional reserve just like banks. For every 100 ounces of paper gold traded, there might be only 1 ounce of actual metal backing it. Now look at the Middle East, China, India, Russia. They don't trust paper. Cultural memory of currency, collapses, wealth confiscation, and broken promises runs deep. When Turkey's central bank bought 75 tons of gold in 2025, they demanded physical bars delivered to Ankara. When China added 220 tons, they took delivery. The $240 premium you're seeing in Dubai, that's not irrational behavior. That's a trust tax. That's what you pay when you refuse to believe that 100.1 paper-to-metal ratio is sustainable. Let's break down this $240 premium forensically, because buried in these numbers is a 5-alarm fire that nobody's talking about. Normal markup is $30 to $50 per ounce for transport, refining, and retail profit. Current premium is $240, $300 depending on form, bars versus coins. That extra $200, $250, pure supply shortage signal. According to November 2025 data from Discovery Alert, COMEX registered gold stocks, that's gold available for delivery, dropped from 45.1 million ounces to 43.6 million ounces. That's a 1.5 million ounce decline in 1 month. Meanwhile, eligible stocks, gold stored but not available for delivery, keep rising. What does that tell you? Banks are storing gold, but they don't want to let it go. Switzerland processes about 70% of the world's gold refining. And right now, according to reports from Delta Harbor in October 2025, they're running at maximum capacity with growing backlogs. Wait times for large bar delivery, 12 weeks, 1 ounce coins. Premiums have hit $400 per ounce in some markets. Think about that. For a single coin, people are paying double the paper price just to hold metal. The World Gold Council's Q3 2025 report confirmed central banks added 220 tons of gold in just that quarter alone. That's 28% higher than Q2. Year to date through September, 634 tons. And these buyers, China, Russia, Turkey, Poland, India, they're not playing with paper futures. They're demanding physical delivery at whatever premium exists. History is screaming at us right now because this isn't the first time we've seen premiums explode before prices went parabolic. When the Hunt brothers tried to corner the silver market in 1979, 1980, premiums for physical silver exploded months before the price shot from $6 to $50 per ounce. Why? Because people who understood what was happening scrambled for physical metal while paper traders were still living in fantasy land. Gold hit $1,900 in September 2011. But go back 6 months earlier, Asian premiums were already spiking to 100 plus. Smart money in the East saw it coming. Western paper traders were blindsided. March 2020. Gold spot price, $600. Physical gold premiums, $100, $200 per ounce. Why? Because when fear hits, nobody wants paper promises. They want metal in hand. Within 6 months, gold rallied $600 to hit $260. The pattern is clear. Premium surge, then paper physical disconnect, then price explosion. Time lag? 3 to 9 months historically. We're in month 4 of elevated premiums right now. So how do we know this isn't just temporary? Let me give you 4 red flags that confirm. This physical shortage is real, and it is accelerating. Signal number 1, central bank buying acceleration. According to the World Gold Council, central banks bought 220 tons in Q3 2025 alone. For context, that's higher than almost any quarter in the past decade, except during the 2022 crisis. But here's the key detail. They're taking physical delivery, not accumulating paper positions. When Russia adds gold, it goes to vaults in Moscow. When China buys, it disappears into Beijing's reserves. This isn't speculation, this is strategic accumulation. Poland has added 67 tons in 2025. Turkey continues aggressive buying. Even South Korea, which hasn't bought gold since 2013, is now considering additions. These are sovereign nations positioning for a currency crisis. Signal number 2, Swiss refinery bottlenecks. Switzerland refines 70% of the world's gold. And according to LinkedIn posts from industry insiders in November 2025, refineries are running at max capacity. Wait times for large bars? 12 weeks. The longest since the 2020 panic. Why the backup? Because Eastern buyers are demanding London bar gold be melted down and recast into forms they trust. 400-ounce bars from London get turned into kilo bars for Asian markets. Every ounce flowing east is one less ounce available in the West, and those ounces aren't coming back. Signal number 3, COMEX delivery stress. The COMEX, America's Gold Futures Exchange, is showing classic signs of strain. Registered gold available for delivery is dropping. It fell 1.5 million ounces in just November 2025. Meanwhile, eligible gold, stored but locked up, keeps rising. Translation? Metal is in the vaults, but owners won't release it for delivery. They're holding tight. When futures contracts come due and someone demands physical delivery, where's that metal coming from? Signal number 4, the premium is widening, not narrowing. 6 months ago, Dubai premiums were $50. 3 months ago, $150. Today, $240, $300. That's not normal profit taking. That's panic buying in slow motion. If this were a temporary supply blip, premiums would ease as more metal arrived. Instead, they're compounding. Why? Because the deficit is structural, not cyclical. Let's step back and look at the raw math. Because the fundamentals here are absolutely brutal for paper gold. Global gold mine production, roughly 3,000 tons per year, with 2025 seeing only a modest 1.3% increase according to Precious Metals Poised analysis from November 2025. Global gold demand north of 4,500 tons per year when you include jewelry, central banks, investment, and industrial use. That's a structural deficit of 1,500 tons per year. So where's the extra gold coming from? Recycling and paper IOUs. Here's the dirty secret. The paper gold market can print supply. A futures exchange can sell 100 contracts for gold that doesn't exist, hoping only 5% demand delivery. An ETF can issue shares backed by unallocated gold that's counted multiple times across different institutions. This works until it doesn't. In a normal market, when Dubai gold hits $2,990 and London gold sits at $2,650, arbitrageurs should buy in London and sell in Dubai. Why isn't that happening? Because you can't easily convert paper gold in London to physical gold in Dubai. The refineries are backed up, the logistics are jammed, and London vault holders don't want to part with metal. The price gap exists because the markets are separate. Eventually, one of two things happens. Option A, physical premiums normalize, requires massive new supply, not happening. Option B, paper prices shoot up to match physical. I'm betting on option B, and when it happens, $2,890 might look like a bargain. Before we go further, let's talk about the single biggest risk facing gold investors right now, owning the wrong kind of gold. If you own shares in GLD, IAU, or any major gold ETF, pull up their prospectus right now. Scroll to the section on redemption and delivery. You will find language like, physical delivery is not available to retail shareholders, or delivery may be suspended at the trust's discretion. Translation: in a shortage, when physical gold is trading at $3,500, but paper gold is stuck at $2,800, you get cash settled at $2,800. You thought you owned gold. You owned a claim on a fractional reserve system. Even when you store gold, there's a huge difference. Unallocated means you own a share of a pool. The bank or vault can lend it out, use it as collateral, count it multiple times. Allocated means specific bars, serial numbers, segregated storage. Yours and only yours. Guess which one costs more? Allocated. Guess which one actually protects you? Allocated. That $240 premium in Dubai? That's not overpaying. That's insurance against the paper system collapsing. Pay $240 extra now, or pay $1,000 extra later, when everyone realizes their ETF shares won't convert to metal. Let's talk about why mainstream media and financial institutions want you to ignore this premium. Turn on Bloomberg, CNBC, Wall Street Journal. What do they say about Dubai premiums? Irrational Middle East behavior. Cultural preference, not economic reality. Premiums will normalize once sentiment calms. This is gaslighting. Financial institutions love paper gold. They collect fees on ETFs. They earn spreads on futures. They use unallocated metal to leverage their balance sheets, 100-1. If everyone demanded physical delivery tomorrow, the system would collapse. So they have to keep you believing that paper gold is good enough. The narrative that Middle Eastern and Asian buyers are unsophisticated or paranoid is absurd. These are the same people who've navigated currency crises, hyperinflation, and wealth confiscation. They're paying $240 extra because they remember what happens when paper promises evaporate. They'd rather pay $300 premium now than discover in 2027 that their gold was just a database entry. The paper gold system runs on one thing: your confidence that it's real. The moment large numbers of investors demand physical delivery, it's game over. That's why the premium must be dismissed. That's why Eastern buying must be downplayed. Because once Western confidence breaks, watch out. So where does this go from here? Let me give you 3 scenarios ranked by probability. Scenario 1, premium normalizes. 10% probability. For premiums to drop back to $30, $50, we'd need mine production to surge, not happening, only up 1 to 3% in 2025. Eastern demand to collapse, impossible, with inflation raging globally. Paper gold to regain trust after this split, unlikely. This is the mainstream narrative. It's also the least likely outcome. Scenario 2, 2 separate markets. Emerge, 30% probability. London stays at $2,750. Dubai hits $30,200, then $30,500. The markets split permanently. Paper gold becomes a casino for speculators. Physical gold becomes the real monetary asset. Westerners holding paper watch in horror as real wealth flows east. This is the nightmare scenario for the financial system. And it's already starting. Scenario 3, convergence upward. 60% probability, most likely. The paper price is forced to match physical reality. London gold jumps from $2,750 to $2,890, then $3,500, then $5,000. Why? Because paper holders panic and demand delivery. The COMEX can't deliver. ETFs suspend redemptions. Price explodes. Timeline? Based on historical patterns, 6 to 18 months from now. By Q3 or Q4 2026, I expect we'll see the LBMA survey prediction of $5,000 gold come true. And the people paying $2,890 in Dubai today will look like geniuses. Let's bring this home. The same ounce of gold, 2 prices, $2,150 in London, $2,890 in Dubai. That $240 gap isn't a pricing error, it's a truth signal. It's telling you that paper gold and physical gold are separating, that the fractional reserve game is breaking, that smart money is paying any premium necessary to get out of paper and into metal. The premium doesn't lie, the spot price does. Your action items. 1. Audit your gold holdings. Do you own physical metal or paper promises? 2. Understand allocated versus unallocated storage. Only allocated protects you. 3. Watch these 4 signals. Central bank buying, refinery wait times, COMEX registered gold and premium trends. 4. Subscribe to this channel for weekly updates as this story accelerates into 2026. Hit that notification bell. 5. Drop a comment below. Are you holding paper or physical? I read every single one. In my next video, I'm breaking down exactly how to buy physical gold without overpaying on premiums. Where to buy, what forms to choose, how to store it securely. That video drops in 48 hours. Make sure you're subscribed. Remember, in the battle between paper promises and physical reality, reality always wins. The only question is, will you be holding the right asset when it does? I'll see you in the next one.